Hey guys, did you know that you can take an IUL policy, which is also known as an Index Universal Life policy, and put extra cash into it? And why would you do something like this? Well, it's a way to store and protect money and take advantage of those upside gains and the floor that's in the IUL. But if you do this, you got to be aware that if you do it wrong, it can cause a lot of problems. There's a tax rule called the Modified Endowment Contract. If you run afoul of that, it can kind of mess up your tax advantages in your policy. So Jason Herring, our IUL expert, he's often giving examples on our channel, and I wanted him to comment on this. He just did an overfunded policy with one of his clients, and he gave a couple of examples in this video that I wanted you to see. And basically, he talked about two different ways that this could be approached. So let's listen to Jason, and then at the end of this video, I'll jump back in. If this applies to you, I'll give you a couple quick action steps. Take it away, Jason.
Hey, thanks, Steve. Hello, everyone. Jason Herring here with Insurance and Estates, serving as your IUL specialist. So today, let's talk a little bit about overfunding an Index Universal Life policy. So what does that mean? What does it mean when I say to overfund an insurance policy? Well, the simple definition to overfunding a policy is to pay or place more premium into the policy than what is needed to cover the actual cost of insurance, of the death benefit, plus any other fees inside this policy. Inside of every policy is going to be a death benefit. There's going to be some other charges. So overfunding a policy is simply just putting more money into the policy than what's needed for that cost. And that additional money that goes into the policy is going to end up here in your accumulation value inside of your cash value to start growing and giving you access for loans inside this policy. So, but you have to be careful when you're overfunding these policies that you're doing it the correct way. One of the great things about working with us here at Insurance and Estates is that we have the experience and the knowledge to design these policies not only the correct way for you, but we also take the time to listen to you and what your goals are and figure out which design do we need to go with on the front end that will also give you room to grow into this policy as you age and as income increases and other things in your life that allow you to place more money into this contract. So to give you an idea of how we overfund these policies and the types of options that you have for an overfunded policy, let's take a look at a case study of, this was a female, age 33, that came to us here within the past year. She had been doing some research around Index Universal Life and wanted to add this asset to her portfolio to take advantage of some tax-free retirement income one day when she retires. So we had a $500 monthly plan premium for 20 years. And what we did with this first design is we took the $500 per month and we had our software solve for what's the least amount of insurance that she has to purchase based on a $500 monthly premium and the policy still be favorable in the eyes of the IRS. So what we're looking here is what we call the minimum non-MEC death benefit. So the MEC, the MEC that we're talking about, that stands for Modified Endowment Contract. And when you're designing these policies, we have to make sure that these policies will never become a MEC, because if they were to become a MEC, then you would lose your favorable tax status from taking loans from a policy. So in this first example, what I first showed to this client was we can take basically a $6,000 annual premium, and the least amount of insurance that you have to purchase is right at about $176,000. So how do you know if that is the correct number? How do you know if that is the least amount of insurance that you have to purchase? Well, the nice thing about these illustrations, if you know where to look, they will tell you exactly where to look for that number. So when you drop down into this illustration, you'll see a set of numbers here, but the main number you want to look at is this guideline maximum level premium. This is basically showing us our maximum amount of premium that we can put into the policy on a yearly basis and the policy not become a MEC. And you can see that we are right up against the MEC limits here at $6,000.01. So it's very easy to show this client that this is the absolute least amount of insurance that you have to purchase. And you can see how her cash values grow over the years based off of this. So this is what I would call a very lean design. Okay, this is a design that has been built to maximize cash value, finding the least amount of insurance that this client has to purchase. But there is some downsides to this. And one of the biggest downsides to this design is the fact that this client would be locked in at $6,000 per year. They could fund less if they wanted to, but they can't fund more. So for a 33-year-old female client who is just really coming into some of her maximum earning potential years, she's really locked into not being able to put any more additional money into this policy. So what we did was we went in and we showed her a second design. And instead of, we're keeping the premium the same at $500 per month. So we have a $6,000 plan premium. But instead of having our software solve for the least amount of death benefit that we have to purchase, I just went in and chose a death benefit of $300,000. So we're moving from $176,000 in death benefit to $300,000. So what is the benefit for the client to do this? Well, the client still will have a planned monthly premium of $500. But what happens if this client gets promoted at work, changes jobs, changes professions, and has more money, available for additional premium? Well, let's go back and look at our MEC number. Well, if we go back and look at the guideline maximum level premium, we see that this client now has moved from $6,000.01 to be able to put $10,150 per year into the policy. So what that means is the client will continue to pay their $500 monthly premium. So that also equates to $6,000 per year. But if more money becomes available to the client, then they can overfund this policy even more than the $6,000 they're putting in. They have what I call, they have room to fund now up to $10,100 and whatever that was, $52. So that just simply means that sometimes during a policy year, if the client has more cash available, they can fund this policy and put more cash into the policy. So the downside to this, or maybe the argument to this that I hear sometimes is, well, this policy is not optimized, right? We're paying for more death benefit. What if this client never puts in that additional $4,000 and just sticks to their $500 plan premium? Well, the key to that is to make sure you're using a product, you're using a chassis like we do with this Mutual of Omaha with their Index Universal Life policy. If you're using a policy that has very low cost inside the contract, like this one does, then it doesn't really make that big of a difference. If you start comparing some numbers here, you'll see that based off of a death benefit that is a minimum non-MEC death benefit, year 10 cash value numbers of about $72,149. If you compare that to the $300,000 death benefit, you've got cash values of about $69,654. So a couple $1,000s in cash value is giving you the option to overfund this policy even more than $6,000 per year and turn this into something very special down the road. So guys, it's really important when you're working with agents and working around Index Universal Life that they are asking you, what are your goals? What does it look like for you 5, 10, 15 years down the road? Because we can certainly start you with a policy with a minimum non-MEC death benefit and find the least amount of death benefit that you have to purchase. But as your income rises, you're really locked in with this policy here, and the only way to put more money into this policy would be to start a second policy. So it's great to work with people that are going to listen to you, that are going to find out your goals, and that have the knowledge to design these policies the correct way to benefit you not only today, but 10, 15, 20, maybe even 30 years into your life and your goals setting up for retirement. So guys, I hope you enjoyed this video today. Hopefully you understand a little bit more about what it means to overfund an Index Universal Life policy. I have a lot of fun making these videos. There are several more coming your way. and I look forward to when we get a chance to talk again. Thanks, Steve. I will turn this back over to you.
Thanks, Jason. Great example. So you guys saw the two different options that Jason gave his 33-year-old female client setting up this policy. One of them was to create a maximum of $6,000 going in. The minimum on that was about $1,100. So there was no extra room if she were to get promotions, make more money down the road. She was kind of capped at the $6,000 annual cash going into the policy. Now in the second one, Jason created more room. So the $6,000 was more of a minimum, and his client had a lot more room to put cash into the policy. So just two examples. The design is really important. The other key is that Jason did the math in order to avoid the MEC rules, which is really important in designing these policies. So point being, if you want to overfund, you got to do it a certain way. If you guys want to schedule with Jason, his calendar link is going to be below wherever you're watching. I encourage you to do that. Also, leave questions, comments. We will respond as long as you keep it classy. Thanks so much, and we'll see you in the next one.